Hello and welcome to the Engaging Economics webinar series, brought to you by the Master of Science in Applied Economics program and the Johns Hopkins University Office of Advanced Academic Programs. Today's event features a discussion on the U.S. economy in 2026, resilience or recession. Please note today's event will be recorded and uploaded to the AAP YouTube channel under the Engaging Economics playlist. During the program, if you have any questions, please feel free to use the Q&A function, and we will answer as many questions as possible during the latter portion of the event. With that, I will turn over the presentation to our moderator, Dr. Prakash Loungani, Program Director for the Master of Science in Applied Economics program.
Thanks, Natalie. Welcome, everyone. I'm Prakash Loungani. I'm the Program Director for the Master of Science in Applied Economics program here at Johns Hopkins. And this is by way of informing our students. I'm proud to say that Forbes 4 months ago ranked our program as the #1 online master's program in the country. So you've made a very wise decision, and I hope you will feel that as you go through the program. Some of you are in my macro or economic growth class, and of course you can complain to me about those courses. But as program director, I'm also the person you complain to about anything else that is going wrong. But I hope things are going right and that you can simply tell me that things are going okay. All right. So today's topic, as Natalie said, is the U.S. economy in 2026.
Great.
Resilience or recession. We have 4 panelists, Torsten Slok, Jason Furman. Torsten, I may have mispronounced your last name. Despite all these years at the IMF, I never learned to say your name right. I'm sorry. Peter Coy and Betsey Stevenson. Okay. So I'm going to start out by asking each of the panelists the same question. In 2025, the US economy ended up doing quite well, actually. 2% income growth and 2.5% inflation. A pretty good year, you would say. So my question to you, panelists, is what do you expect for this year? And I'm going to give you 3 choices. I know I'm holding up 4 fingers, but I'm giving you 3 choices. 1, resilience, by which I mean that the economy will do roughly the same as it did last year, about 2% income growth and 2.5% inflation. The second choice is stagflation. Stagflation would mean that income growth goes down a little bit and inflation goes up a little bit compared to last year. And the third choice is recession, which is that GDP will actually decline, say because of the bursting of an AI bubble. Okay. And stagflation could happen for a variety of reasons, particularly the impact of the tariffs finally taking hold. Okay. Now, why am I holding up 4 fingers? Because I suspect that even though I've given you 3 choices, all of you will choose a 4th choice, which is to combine my 3 scenarios or construct a scenario of your own, which is fine. So let's start with you, Torsten. What do you expect? Resilience, stagflation, or recession?
So the answer to that, and thanks so much for organizing and for having me, Prakash, is that I think that the US economy will continue to be resilient. So if I just share my screen and show 2 slides. When we think about last year, there was a lot of headwinds coming from the trade war, not only from tariffs on their own, but also from trade war uncertainty. There were also headwinds because of immigration restrictions holding down employment. But as we look into 2026, we begin to see a growing list of tailwinds rather than headwinds. Number 1, yes, I do understand that there's still a lot of uncertainty about trade war, but let's just agree that the trade war uncertainty situation is at least better than what it was in April of last year. Number 2, we still have a strong AI and data center spending boom. Number 3, we also have high AI stock prices boosting the wealth effect for consumers. We also have the dollar has been going down, oil prices have been going down, and we also have over the summer the World Cup soccer. I know this is a little bit special, but the conclusion is that this is also something that is likely to give at least some lift to GDP growth over the next several quarters. And finally, we have as the last 4 points also the one big beautiful bill. The Congressional Budget Office quantifies that the one big beautiful bill will lift GDP growth by 0.9% in 2026. So this is fiscal policy becoming very expansionary relative to what we had last year. So taken together, we think that the story has changed from there was a lot of headwinds. We worried a lot about stagflation last year to now beginning to look instead at all the tailwinds, especially tailwinds coming from expansionary fiscal policy, but also tailwinds coming from the ongoing AI boom, and also tailwinds from the dollar going down and from oil prices going down. And this is now resulting in this forecast that you see here. This is the consensus forecast, and the consensus consists of about 60 people who submit their numbers to Bloomberg. That's what you see in the white numbers. The orange numbers is the historical data. And if you look at the squared box in the middle for GDP, what is the consensus saying? What is the market's prediction of what will happen to the US economy over the next 18 months? And as you can see, the expectation is that GDP growth from the first quarter of 2026 is expected to be 2.1, 2.0, 2.0, 2.0, 2.0, 2.0. So honestly, this is actually a quite boring forecast because this is just saying that growth will exactly be at potential for the forecast period. But what is much more exciting and much more interesting is the last squared box, because what is the consensus saying about inflation? And as you can see, inflation has been going up from 2.4 to 2.9. And now the consensus forecast is that inflation will be 3.0, 2.9, 3.0, 2.8. And only when we begin to get into 2027 will inflation begin to go down towards the Fed's 2% target. Why is that important? Well, this is extremely important because it tells you that this squared box is likely the exact reason why Jay Powell went out and recorded a video on a Sunday evening, because inflation is expected to be 3. And the Fed has been mandated by Congress that inflation should be 2. And given 2 is not 3, that means that the Fed will have a really hard time cutting interest rates anytime soon when inflation continues to be as elevated as it is in this forecast. And the last thing that's interesting in this chart is in the upper right-hand corner, and this really is, to me at least, quite surprising. So the probability of recession, according to the consensus over the next 12 months, is 30%. So why is it that the consensus is so worried about? If you just look at the GDP numbers, you could say, well, where is this slowdown? Why is it that the consensus worries about a much harder landing than a 2% growth outlook? And maybe the reason is that the consensus is worried about consumer spending beginning to slow down. We have a K-shaped situation for consumers. The lower leg of the K is not doing very well. It could be that that would grow to such a large share of the population so that that could begin to drag down overall consumer spending. It could also be that another risk is that AI will begin to slow down. It could also be that the consensus is worried about geopolitical risk. We don't quite know. We can only speculate. But what is very important for investors is, of course, that the consensus is telling you that there is almost a third chance of a recession. So therefore, yes, there's a 70% chance of not having a recession, but it is still a very elevated number. Normally, that number stands at around 10-15% in normal circumstances. So the bottom line is, when we think about the economic outlook, the answer is that there are some tailwinds that are raising the risk that we may have not only resilience, but maybe re-acceleration. But the backdrop continues to be one where inflation just continues to be elevated. And that, of course, complicates the situation for the Federal Reserve, which makes it a lot harder for them to cut interest rates anytime soon. So with that, let me stop there, Prakash, and turn it back to you.
Okay, thanks, Torsten. I forgot that ChatGPT had advised me to emphasize my personal connection to each of the panelists. So, Torsten, you and I were both at the IMF, but I don't think we were in the same department at the same time. Jason, I don't think we were in the same circles. I have a recollection, though, of you being the discussant of my book at the Peterson Institute. ChatGPT didn't advise me to do something crass like holding up my book. That's just me. I remember, Jason, that you said that this was the best book with a yellow cover that you had ever read.
So it's great to be with all of you. So many friends on this discussion.
So what do you expect? Resilience, stagflation, or a recession?
So if I had to pick one word, it would be resilience. If I had to pick a set of numbers, they would be better than the ones Torsten showed you, and that there would be higher economic growth a bit and lower inflation a bit. But let me step back and say 3 broad things about how to think about the economy at any point in time, not just this year. The first is that we all put lots and lots of effort into economic forecasting, But the fact is, a forecast which says next year will be the same as last year is on average better than most other ways of doing forecasting. If you get really fancy, you can improve on it. If you have several hundred PhD economists at the Fed, you can do a better job than what I just said. But that works pretty well. And if you do that way of forecasting, you get economic growth this past year was probably around 3%. We don't have the fourth quarter numbers yet because of the shutdown. They're going to be delayed past when you'd normally get them. And the inflation rate was, I think, when you sort of unspool some of the weird technical measurement issues, was more like 2.5% this past year when you ignore imputed prices. And so for next year, you'd sort of start with that as your forecast. The second thing is the second rule of forecasting is just don't adjust it very much for the president and their policies, no matter how much you like that president or dislike that president. I think presidents do matter for economic policy. I've certainly worked with Betsy and President Obama because we wanted to make the economy better. But a lot of what presidents try to do also is affect things like how many people get health insurance, what the distribution of income, things that don't actually show up in GDP on average or inflation on average, as we're discussing here. President Trump's tariffs were so dramatic that I thought they would break that second rule, and I think they have affected the economy, and I think we have higher inflation today because of them and lower GDP because of them. But even they are not quite as big as you might otherwise think. And as Torsten said, at least for short-run macroeconomic performance, there are some puts and takes. I think the tariffs are hurting, but tax cuts in the short run help. I think they probably hurt in the long run. And then on regulation, you've seen areas where the economy's been deregulated, areas where it's actually been more heavily interfered with. Over time, I think we'll probably have slightly lower economic growth because of all the different things we've done. But, as I said, it's sort of all much smaller and less dramatic. In fact, if you look at the macro data, you would not really see a big distinction between the year 2024 when Joe Biden was president and the year 2025 when Trump was president. Similar inflation rates, similar growth rates, similar interest rates, similar magnitude of increase in the unemployment rate sort of go down the line. Again, this is to a first approximation, to a second approximation. I think inflation would have fallen in 2025. The tariffs prevented it from falling. So I'm not saying policy doesn't matter. I'm saying it matters less and there's less sort of dramatic breaks than you think. So the first rule is that last year is like this year. The second rule is don't change that very much for the president. The third rule is that next year is really, really hard to predict. So how does this relate to the first rule? Well, the first rule says on average it's like last year. The third rule says yes, but it will be wildly different. We just don't know in which way it will be wildly different. I right now think we're mostly seeing AI on the demand side, all the money that's being spent to build data centers and to power them, and that's been helping economic growth. I think we're not seeing it in a huge way on the supply side in terms of higher productivity, but who knows? Maybe this could be the year where we start to see it more on the supply side. Maybe there'll be a war in Iran and that will destabilize the whole region and that will be like a supply shock, a negative supply shock. Maybe we'll dramatically escalate tariffs on China. The president will go there in April and we'll have a bad meeting in China and things will happen. So all sorts of things, either better or worse than you think, could happen. So be really humble. The last thing I'd say though is the thing I think is is least likely at this stage is stagflation. I think it's least likely because if we have a market deterioration in economic conditions, a big increase in the unemployment rate, that would put downward pressure, tend to put downward pressure on inflation. My favorite measure of labor market looseness is job openings to unemployed. That's already quite low. There are just not that many jobs for every unemployed person looking for one. So if anything, there might be some downward pressure already on inflation. We've seen nominal wage growth in the process of slowing. So if the United States went into a full-blown recession, then my expectation is that would mean less inflation, not more, given that underlying inflation is around 2.5%, that might actually get us to the 2% target. Now, even that last one's not certain. For example, a dramatic shock in global oil prices could increase inflation and increase the risk of a recession. But for the most part, contingent on saying the economy is worse than I think, I would say inflation is lower than I think. So in sum, next year will be like 2025. 2025 was like 2024. 2024 was like 2023. And all of that says that the US economy, most of which is domestic, most of which has nothing to do with tariffs, nothing to do with what the president does, will continue to be quite resilient.
Okay, thanks very much, Jason. Just a note to the panelists, I'm going to circle through once, getting your views on 2026, and then come back and get your medium-term and longer-term concerns about the economy. So let me turn to Peter. Peter, same question. How do you see 2026?
Well, I want to thank you for having me on, Prakash. I'm the only non-economist on the panel. I'm honored to be on with such illustrious economists, and I'll do my best to say the kind of things an economist might say, but to just take it as the point of view of a journalist who's reading what other people say and reading the tea leaves. I've tended to be bearish. I was wrong in predicting that there would be a recession when the Fed started jacking up rates to knock down inflation after the COVID recession. A lot of people made that call. I just stuck with it too long. And and so I guess I'm congenitally bearish. As Jason accurately said, the safe thing to do is predict growth, because the economy usually does grow. And secondly, you kind of never know when a recession is going to hit. It's a very nonlinear phenomenon. Things can be seemingly to go along swimmingly and then suddenly crack. And that's the way a lot of recessions begin, without much warning. In fact, often we don't even recognize that we're in a recession until well after one has begun. That's what happened in the recession that began in December 2007 was not identified as a recession until the following summer, when it began to gather force. So rather than accentuate the positive, I'll call out some of the negatives, things I worry about. One is the reason that the problem to me is mostly with the labor market. The unemployment rate is reasonably low, but that's mostly just because of slow labor force growth. Labor demand growth has shrunk quite a bit, and the number of jobs added to payrolls has fallen off a cliff. In fact, if it's true that the birth-death model is overstating employment growth, we may be actually losing jobs already, or have lost jobs in the fourth quarter of 2025. So at the same time, we have incredibly ebullient financial markets. And to me, that is a bearish sign. Torsten talked about how, AI and enthusiasm about AI has been a big positive for the economy, which it certainly has. But you could interpret that in a negative way. You can say that the market's priced for perfection, and that the investment of the giant tech companies is also priced for perfection. If they see any faltering in demand for AI and they cut back on investment, that would be really a serious blow to the economy. And if the financial markets react badly to that or to other things, and you get a break in the stock market, there goes your wealth effect. So, I mean, right now, the cyclically adjusted price to earnings ratio, which is Robert Shiller's thing, is at the second highest level since the late 19th century. The only time it was higher was the end of 1999, which is, of course, the tech bubble that burst. Cash levels are at a record low. I think Torsten also cited the tailwinds coming from tax refunds in 2026, as well as tax cuts, such as um, tax tip on earnings and so on. Um, I, I'm focusing on the withholding and refunds. I think we've seen in the past that consumers don't respond as positively to such things as one would expect. And I think it has something to do with uh, sort of the life cycle theory that I don't want to go all Robert Barrow here, but the idea that they're kind of foreseeing that maybe things are not going to be good for the long term and they don't want to spend every dollar that they get back from the government. Um, so the big issue is now what the Fed, not the big issue, but a big issue is what the Fed's going to do if the economy does show further signs of slowing. Jason pointed out that the inflation is above target, and that is one reason not to cut rates. But will the Fed stand back on cutting rates even when rate cuts are needed to sustain the economy because it's putting too much weight on the high above target inflation number? Secondly, will the Fed, in order to show its independence from Trump, lean against needed rate cuts, even when that would be a mistake for the economy? And I have more that we can talk about if we go into a round hall, but I want to close with a sentence from Michelle Bowman, one of the Fed governors, who was calling attention to some of these same issues in a speech quite recently. And I'm going to come back to the labor market. Her bottom line was the labor market can appear to be stable right up until it doesn't. That's it from me.
Okay. All right. Thanks very much, Peter. I meant to mention when turning over to Peter that for 20 years I had carried around a Business Week issue in which he had cited my work on the inability to forecast recessions. But when I needed it, I went down in the basement. Of course, I couldn't find it.
Gosh, I should have cited you because that's perfect for what I was trying to convey. Recessions are inherently unpredictable.
Yeah. But it's fine. You did cite me in Business Week, which
Okay.
really was influential for me at that stage in my career. And I felt that, nobody read what you wrote, and it was read by one editor and two referees who were always critical. So knowing that somebody else in the real world read my stuff was very important for me at that stage. Okay.
Right.
Okay, we'll turn to Betsey. Betsey, you may not remember this, but I remember you as a research assistant at the Fed when I had just joined. Of course, I've seen you go on to greater things ever since.
Yeah, of course. Prakash, you will always be a senior economist to me.
Yeah.
I was a research assistant looking at these senior economists coming in, and that's how I ended up in graduate school. So thank you. Thanks for being such a good role model.
Okay, so Betsey, by now you know the question. I won't repeat it.
Yes. So, you've pretty much gotten very similar answers from everyone, which is I expect the economy to be resilient, but I'm just going to emphasize that I expect that for the reasons that Jason and Peter outlined, as well as some of what Torsten said, which is if I've got to form an expectation, the best expectation is that it looks like what it did last year. So that's a really good guess. The other thing is, the more colloquial line, Peter, is, booms don't die of old age, something murders them. And the thing is, it's really hard to predict when the murderer is going to come out from behind the shadows and kill our economy. We were sitting there it was just such a really good example of that during the pandemic, because we were having all these discussions about the ways in which the 10-year boom might come to an end, but almost nobody had. Giant pandemic sends everybody into lockdown on their bingo card of what was going to cause a recession. And so I think that we could end up in a recession next year, but I think there are a lot of different potential causes for it, many of which we don't even know. So the best thing is to think it's pretty much going to be resilient. But I wanted to highlight a couple things we haven't talked about. The first one is we haven't talked about consumer confidence. And so one of the things that I'm most worried about is consumer confidence does seem to be falling off a cliff. And if I am just going to check my microphone because someone just said they're having a hard time hearing me. Is that any better?
We hear you.
I think it's fine. Yeah.
So if we're thinking sorry, I think I was talking about consumer confidence and the fact that we've seen pretty big declines in consumer confidence. In fact, the Conference Board Index of Consumer Confidence declined by 9.7 percentage points in January, and this brings it to its lowest level since 2014. One of the reasons why growth sort of exceeded expectations in a number of years coming out of the pandemic was consumers just kept spending. They kept telling us they felt terrible about the economy, but they kept spending. So the question is, how much weight should we put on these consumer confidence numbers? And will people finally start putting their money where their mouth is? So one reason they might start putting their money where their mouth is because we do see a slowing labor market, as Peter already talked about. This slowing labor market's happening in a particular way, though. It's not happening through a lot of layoffs. It's happening through there not being a lot of job openings. So this is a game where if you have a job, that's great, keep it, not a good time to leave unless you have another offer in hand signed on the dotted line. This is not a time to think about quitting and exploring to find better options because there's not a lot of hiring going on. And what that does is puts downward pressure on wages. So that's why I think that I'm not as worried about stagflation as Jason said, because I think we have this sort of I do think we have kind of a natural downward pressure coming on prices from the fact that wage growth is slowing. And I think what was pushing prices up in the first place was tariffs. And that's, as we all know, like a one-time jump up in prices. I don't think it's all priced in yet, but I think we're getting there. And even if there were more tariffs, again, it's sort of like a one-time jump up in prices. So that's not really my concern. My concern is the labor market and thinking about who is getting shut out of this labor market and, what that will mean. And I think we should also remember that we can look at the data and say, okay, actually maybe growth is fine, but there's still a bunch of people who are getting harmed by this economy. So we're having more of a bifurcation where we've got a growing number of people who are unemployed and unemployed for a long time, but everybody else is doing really fine. And that's, I guess, another version of the K-shaped economy, but that's a worse economy than an economy that is growing at 2%. And we have sort of the normal dynamism that comes from new businesses starting and jobs coming about. I think the last, so the thing about the stock market seems to matter here because it's a big source of income from a bunch of big spenders like the baby boomers who are looking at their retirement portfolios and deciding how much consumption they can have. And so far, a bunch of older people with big consumption have been doing great, even if the labor market's not doing great for them. And if what we're seeing is the youngest people getting harmed the most from the labor market, they may not have an immediate large impact on overall spending because they're a pretty small share of spending overall. So, if we see college students cutting back, or people right out of college cutting back their spending by 10%, that's probably not going to have as big of an impact as if we see sort of people who are in the prime of life, who are usually spending a lot more, cutting back their spending by 10%. And what we're starting to see is a labor market where younger people are finding it harder to find a job. Maybe that's because of AI, and maybe it's just because we're in a labor market where there's not a lot of hiring going on, and they are outside the labor market. They're trying to enter. Either way, I think we end up with young people who are going to get increasingly frustrated. So we have low consumer confidence, we have a stagnating labor market, and then we have sort of ongoing tensions around immigration. And I think that brings up a big question with labor markets. Is the immigration crackdown, what we're seeing like in Minnesota, is that going to spread to the rest of the country, which we might see a pretty dramatic decrease in labor supply? Or is what's happening in Minnesota going to cause, a little bit of a pause in the pressure on immigration? So, there's a labor demand side, but there's also a labor supply side that I think brings in some uncertainty. So I think that there's risks in the market, and I think overall it's going to be resilient. And a lot of that resilience is driven by this optimism of AI. And so I'll end by just saying, I think, a lot of people talk about whether we're in some kind of AI boom. And I think it's a little bit, I meant to say bubble, some kind of AI bubble. And I think it's kind of different from a classic bubble. Because when we're in like a classic bubble, people are bidding up something, and it's at some point nobody wants to buy this thing. I think what's happening now is we're seeing a lot of gambling on a world in which they think it's going to be a winner-take-all market, and you need to either be there or you're going to get completely cannibalized. And I don't know that that's necessarily wrong, that idea that you're sort of chasing a winner-take-all market. And so we're seeing a lot of business investment, and I think we're going to continue to see that business investment in 2026 as companies continue to chase being a winner in a market in which technological change is going to lead some people to win big and others to get squeezed out. And so, if I'm looking at 2026, what makes me most optimistic that it's going to be resilient GDP growth? It's not consumer spending. It's not consumer confidence this year. It's going to be businesses chasing business investment to be a winner in that new emerging technology market.
Okay, thanks very much. Before I move on to the next set of questions, does anybody want to jump in response to what you've heard? Yeah, Peter, go ahead.
I just want to endorse what Betsy said. I think that's a really excellent point about the big tech companies. We perceive it sometimes as, wow, they must be super confident about the future to be spending so much money. But you can turn it around and say, no, they're scared as hell about the future. And that's why they're spending money, because they know, or they think that if they don't, somebody else will trounce them.
I think, Betsy, I'm looking at the questions that are coming up in the chat. I think, Betsy, you kind of answered one.
Right.
Maybe
just want to
Yeah, go ahead, Jason.
Oh, yeah. Two things. One is, Betsy, I think either I misunderstood you or you misunderstood me. I agree with you that I think there's downward pressure on wages and prices coming from the relatively loose labor market, which is why I think stagflation is the least likely scenario, because if job market deteriorates even more, then I think there would be even more downward pressure, which I think is what you said.
That is what that's what I meant.
Okay, I believe you phrased, anyway, whatever.
I think we both agree with each other. I got very confused by my microphone not working for a moment, and so.
Okay, good. So I want to make sure, because when we are not on the same page, it's usually because I'm wrong. But the fact that I'm on the same page as you on this means I have a shot at being right.
What I was saying is, we've got what has pushed inflation up has been rising wages in the past and the tariffs, and now we've got downward pressure on wages. And we've got the tariffs almost fully priced in, so that the inflation pressure for the future is going down. And even I think if the Fed held steady, I would expect inflation to come down. And, I think that's why what we'll see is the Fed starting to cut, later in this year.
Right.
Unless I think as what, I think, Peter, you said that if they become too committed to doing the anti-Trump thing. But I have great confidence that Chair Powell does the right thing for the economy, and that will be
Yeah, I agree with
probably
that.
cutting rates.
Yeah. I mean, the other thing to understand about tariffs, which was implicit in what you said, even if there's more pass through, if it's the same amount that we've already seen, that would keep the inflation rate the same. If there's more
Exactly.
pass through, but it's less pass through than we've already seen,
It brings it down.
then it
Yeah.
actually brings the inflation rate down, even though it's pushing prices up. So the sort of first and second, the first and
Yeah.
second derivatives here can get a little bit confusing, and I think are something that many people, not you, are missing. The only other thing I'd say is, notwithstanding the best guess is that the next year is like the last year. I would not be surprised if we end this year with a lower unemployment rate than a higher one. It's been very gradually rising from and now 4.4, but the Fed doesn't want it to very gradually rise. It's above where they'd like it to be. And some of the tailwinds Torsten talked about, if they materialize, could have our unemployment rate stabilize or even fall. So maybe a little bit of a tighter labor market than we've seen the last year or two. But even if that
Jason,
happens,
I
it's
would
still
just
a
say
relatively loose labor market.
the reason am hesitant to forecast the direction is that normally you don't have movements in labor demand and supply at the same time, and that's what we're seeing. And so it depends on which one's bigger, and I don't know the answer to that.
Okay, I'm looking at the questions in the chat. There's a question from Karan Bhasin, which I think, Betsy, you kind of answered it. And if you wouldn't mind repeating, he's wondering, by the way, Karan is my co-teacher in the classes that I teach in macroeconomics and economic growth. Good to have you, Karan. So the first question is, would immigration have any effect on output, considering the sharp decline in labor supply? I think, Betsy, you at least mentioned that.
Yeah, so this is where you got to put this labor supply and labor demand together. So, right. If we, it's hard to get productivity measurement in the data. Like you could have a whole webinar on measuring productivity, but if we're seeing some productivity increases, like let's take coding, for example, people are now using Claude to help them. They're coding a bit faster. Demand for coders might go down, but if the supply of coders, because we're not bringing coders in from India anymore, has also gone down, it's just not clear what happens, that there is any negative impact on output. If demand for coders is going up, or even is staying the same, but the supply is going down from India, then we sort of know what happens. That's a negative impact on output. But if what, we're also seeing decreases in demand, then that might be why we don't see, much change in, I think that's one of the reasons we haven't seen unemployment go up by very much this year, is we have seen movements in both the demand and supply curves at the same time.
Right. Thank you. The other question from Karan, and I think you guys have answered it by not mentioning it, is he's asking, let me get to the question again. He's asking whether the weakness in the US dollar, you think of that as being something that will have an independent effect on output or inflation, or you think what's happening to the dollar is a result of the factors you guys have mentioned? So do you want to speak for a minute on the dollar? You see anything that, do we need to keep a separate eye on it as something that may affect inflation? Anybody?
At least from a trade perspective, it's very clear the US is a closed economy, with imports only making up, or exports making up 10-15% of GDP. But it is still the case, sorry for sharing my screen here again, that if you do begin to look at the correlation between what the dollar has been doing and inflation, I realize that this correlation is not perfect, but it still is important to remember that historically, at least, when the dollar has been weakening, and in particular if that weakening happens very quickly, so this is the green line is the dollar, And you can see that here we have inverted the axis, and that is on the right-hand scale. And the dollar has obviously been going down a lot. And the fear you can have is, of course, that will begin to put some upside pressure on inflation. But as Jason and Betsy were saying a minute ago, this effect is relatively small compared to some of the other things that are going on. In particular, housing inflation is also dragging to the downside. If one has to tell a story about inflation being a bigger problem, then it has to be something like what Jason was saying also, that if the one big beautiful bill is going to create a lot more overheating, then we could have a lot tighter labor market. And if you combine that with much lower labor supply, as Betsy also was mentioning, then we have had a very, very significant tightening in labor conditions. This chart here shows you that for the years 2022 to 2024, net immigration into the US was around 3 million. And now the CBO is forecasting that net immigration will drop to 400,000 last year, 600,000 and 700,000. So that means that if we have such a sharp drop in labor supply, and at the same time, if the economy really does begin to accelerate, of course, that would be the recipe for some signs of inflation and, of course, inflationary pressures being a bigger deal. But given that's not the expectation from the consensus or from anyone on the panel, then at this point, there still remains a small upside risk.
Okay, thanks. Let me see what other questions there are in the chat. Jason, I don't know if did you see the piece by Peter Orszag and Adam Posen on inflation?
Yes.
So they are predicting 4% inflation. I guess you don't agree with them.
I say this at some peril because I'm a non-resident senior fellow at the Peterson Institute for International Economics.
To put you on the spot, yeah.
Where Adam Posen is the president. But in, I believe it's 2022, I publicly bet Peter Orszag that inflation would come in above 3%, and I won. And this year, I'd be more than happy to bet him that core inflation at least comes in below 3%, and I'm confident I'd win. Labor markets are already loose. There's downward pressure on wage and price growth. If you look at market PCE, which is the better, more inertial, better predictor of the future, so you take out all the imputed stuff, believe that grew at a 2.4% rate over the last 12 months and has been slowing more recently. And then finally, as Betsy said, and Betsy and I engaged with back and forth, the tariffs coming off will be some downward pressure. Now, what could go the other way? If you have a shockingly dovish Fed, that could go the other way. But first of all, the Fed will make interest rate decisions based on the votes of 12 people, not based on the decisions of the next chair. The next chair themselves probably doesn't want to be way too far away from normality. Moreover, the Fed influences the economy with long and variable lags. And then the second thing I'd say is I think it's likely that at the end of this year, tariff rates are lower than they are now, not higher, because of concerns about affordability, because reaching agreements with countries and the like. As with anything with Donald Trump, I am not very confident in what I just said. It is totally plausible that they're higher. But even there, in order to have higher inflation from tariffs, you basically need much, much more pass-through than we've already seen to date. And that to me is very implausible. So I would, if I had to forecast inflation, I think I'd pick a number between 2 and 2.5, but certainly pick a number below 3.
Okay, thanks.
Sorry, Peter and Adam.
I'm trying to go through the questions again. Well, first of all, many of my students are thanking you for being here, which I should emphasize. It's really a treat for my students to get a break from watching videos with Karan and me and get to watch 4 top economists debating these issues. So it really is a big boon for my students. So all of them are thanking you for being here. There's a question from Stuart Van Horn, which kind of reminds me of a question I've been meaning to ask Torsten. Torsten, suppose government data on output and inflation become unavailable or unreliable. Are there private sector sources that we could trust? So if Jason and Peter Orszag are having a bet, but we don't have good data, can we resolve the bet based on private sources for output and inflation?
Not that specific bet, but there are other sources. And you ask whether they can be trusted. I do think they can be trusted, but are they as good as the government sources? The answer is absolutely not. So that's why a lot of people, including in my little group, we look at daily, weekly, monthly, quarterly indicators in all kinds of directions, in particular during the government shutdown, for evidence of how is the economy doing. This can be everything from daily data for how many people are traveling on airplanes. There's daily data for usage of debit cards. There's also daily data for when you look at how many go to restaurants. There's weekly data also for consumer spending, including from the Chicago Fed, from Redbook. All these things are very helpful indicators, but at the end of the day, they still do not replace the most thorough indicators that we have from the government. So in that sense, yes, so far, and I know there's some discussion literally this week about another government shutdown coming, but at least so far, it is absolutely important and critical, especially for Jason's bet here, that we have the right data to determine who owes who a beer.
Okay.
Can I give the like sort of basic intro econ answer to this question?
Yes, please.
Which is, a lot of people say, well, why don't we just have private sector data for all these things? Why do we want the government doing it? And I don't think it's that the government's necessarily inherently better, but it is the case that there's a lot of fixed costs associated with gathering up all this data. So if you're a private sector company trying to decide, okay, I'm going to be the one who reveals the unemployment rate, you've got to be able to sell it. So then you've got to sell it to people who aren't going to reveal it to everybody, and so then that means that you're not going to give it to some people who have a marginal benefit below the price you're setting it at, even though the marginal cost of giving them that data is absolutely zero. And so there's a whole bunch of benefits to be gained by distributing it to everyone. But the only way to monetize it is to prevent some people from getting it by charging a price that's above zero. And that it's that sort of fundamental problem that means there are some goods that are better provided by government, or at least funded by government, right? So this is about who pays for it. And I think it's really important that people realize, like, we're not in a better world. Oh, the financial sector is so big now, we can just gather up our employment data or our inflation data from private sector sources. We'll never get the good access that is universally supplied to all the people who have some positive value of it through doing it through the private sector.
Hey,
Thank you.
Prakash,
Yeah, go ahead, Peter.
I'll just add to that. That's the intro econ answer. There's also an intro stats answer that goes the same direction, which is that big data is not necessarily good data. Just because you have tens of millions of data points doesn't mean that they are representative of the entire population you're looking at. In fact, there's been research, there's a Harvard Data Science Institute or something like that, a guy I talked to there, who's published on this, found that a statistically representative sample of maybe 1,000 people can be more accurate than a survey that, or not even a survey, but a database that has 1 million responses that are not even pretending to be statistically significant or representative of the general population.
Yeah, let me just say,
beware of what data you're looking at.
Yeah,
Yeah,
the
Jason.
topic of recession is one we're all somewhat interested in. The topic of economic data, we can't help ourselves, but all weigh in on because it's near and dear to all of our hearts. Last thing I'd say is it was very concerning when Donald Trump fired the head of BLS over the summer. It is extremely, extremely hard to falsify government data. There is not a shred of evidence that that has happened. I am worried about deterioration in the quality of data because of budget cuts, because of the way these agencies are managed. That will introduce noise. Sometimes numbers will be too high, sometimes numbers will be too low. I would be very, very surprised if the government was able to introduce bias where they distorted numbers in a way that was favorable to Trump. It is not impossible, but unless you're reading about it on the front page of the New York Times, if you're just reading someone on X who speculated that that had happened, that person on X is almost certainly wrong. Only believe it till you read it on the front page of the New York Times and the Wall Street Journal.
I'll just say as a footnote, the BLS produces both sides of the dual mandate for the Fed, both inflation and employment. So it cannot be emphasized enough how important it is that the BLS is independent.
Yeah, thank you. That was very useful for my students, even though you answered a question that I had put on their assignment.
Oh,
for
oops.
them.
Oops.
Did we do okay?
Yeah, you did well. Yeah.
Yeah, that's right.
Yeah. So I expect people not just to give me Torsten's slide deck, but add to this all the responses that we got from the other panelists as well. So the level of difficulty has been raised on the answer, I expect. Okay. Well, there are lots of questions on AI and the stock market. Torsten, let me turn to you. I read the profile that that was done of you in some magazine. I forget which one. New York, I think. New York.
Yeah, this was a Bloomberg. Yeah.
Okay. Yeah. So in that profile, they asked you, what is your expectation of the return on the stock market over the coming decade? And they said that you held up a big zero. Can you explain why you take that view?
So this is basically based on the very simple observation that valuations, and here we can talk about valuations in different ways. Normally, the PE ratio is done by calculating the P today divided by the E today. And if you do that, the PE ratio at currently around, depending on exactly which stock market and which measure and how you do this, but 22, 23, it certainly suggests that when valuations are at those levels, if you look back in history over the last many decades, then the subsequent 10 years, the stock market does not do very well. Another way of doing this is to look at the Shiller PE ratio. What Robert Shiller at Yale did, what he took the P today, but instead he divided by the E over the last 10 years. And why did he do that? He did that to ask the question, how persistent are earnings? Is corporate America on a more persistent basis able to generate earnings and cash flow? And if the answer is that only earnings have gone up really dramatically in the last few years, well, then, of course, the Shiller PE ratio or the cyclically adjusted PE ratio is a better measure of asking, well, how persistent is the earnings power for corporate America? And that ratio today basically stands at the highest level, meaning valuations in PE measured as the current P divided by the E over the last 10 years, inflation adjusted. That currently stands at the highest level since 1880. So valuations on their own are quite stretched. And the question, of course, becomes what's going on? Well, the risk is, of course, that you have some sectors, in this case, the tech sector, that's able to generate a lot of revenues for a period. But the risk is, of course, if they don't generate revenue going forward, then, of course, that will be the ultimate downside risk. So why would it be a risk that AI would not be generating revenue? Well, if the adoption rate has begun to flatten out, both in the ramp adoption rate, also the census carries out a survey of 1.2 million businesses every 2 weeks where they ask businesses, have you used AI in one of the 4 following ways? Have you used agents? Have you used large language models? Have you used voice recognition, document transcription? And you also begun to see adoption rates flatten out. And we look at the Duke CFO survey, also ask business managers, has AI improved your business's process, meaning improved labor productivity, customer retention? And there you also get the most prominent answer is that there has been very little impact. So let's just agree that there is a lot of potential in AI, but at this point, we're just not quite seeing, and that's also what Jay Powell has said numerous times, that we're not quite seeing it in the labor market, we're not quite seeing it in earnings. And maybe the best last way, I know we're up against time here, but best last way maybe to look at this is to look at consensus expectations to earnings. This chart here shows you expectations to earnings in 2026 for the Magnificent Seven since Liberation Day. And the green line shows you earnings expectations for the Magnificent Seven have gone up. But if this was really an incredibly revolutionary technology that already was having a dramatic impact on the rest of the economy, you would also expect to see earnings expectations for the S&P 493 go up. But earnings expectations for the S&P 493 have done nothing since Liberation Day. So this is telling you that, and this is a daily indicator, we can all monitor this. We got to watch very carefully what's going on with earnings, not so much of the Magnificent Seven, but what about all the companies outside, meaning S&P 493? Are they actually saying that they're seeing the benefits and the gains, and are they ultimately seeing a better bottom line? And the answer in this chart here is, which is literally updated to yesterday, is that there is just no proof yet that this is showing up in higher earnings for companies outside the Magnificent Seven. That's not to say that we will not have our lives change from large language models and other things, but just the last point maybe is, if we take our finance textbook out, When a company invents a new product, for example, Ozempic, like Novo Nordisk did, they have some monopoly profits where they do really well for several years. But what is the product today? Large language models? I don't know what the difference is between ChatGPT and Claude and Gemini and Grok. So if that's the case, we do not have someone who has, at least in large language models, a huge monopoly where they can squeeze profits out. So therefore, the race in the price is going to be to the bottom. And that raises, of course, some challenges also. While there has to be somewhere else that the AI revolution takes place. So yes, AI is certainly going to make a lot of changes, and I do believe that it will lift productivity, but it still remains, of course, to be seen exactly how big those effects will be.
Okay. Peter, you have a reaction to that?
First of all, I agree with Torsten. I would be shorting the hell out of NVIDIA right now if I were the kind of person who shorted stocks. I think that history shows that when new technologies, important new technologies come in, there's a brief period where the companies can charge a lot of money, but ultimately the gains from these technologies go to the general public. It takes a while, but competition asserts itself, prices come down, adoption increases. But that can take, another point is that can take a long time. It can take a long time, for example, for a general purpose technology to filter out and until people really figure out how to use it. So these companies, the market's gotten way ahead of itself in expectations for adoption of AI, number one. And number two, when it finally is adopted, these companies may not be reaping most of the fruits.
I am also not the type of person to short stocks. If I was, I would have shorted Tesla in 2015 when its market value cap was way above all the other automakers. I would have done it again in 2016 after it went up even more, 2017, etc. And I would have lost vast, vast sums of money. So what I do with the stock market is I buy and hold a broadly diversified portfolio. I haven't changed that right now. And in some ways, that's a corollary of my macro view that the best guess is that the economy next year will be like this year. Same thing with the stock market. I can tell all the nervous things that Torsten and Peter said. All of it's completely, completely persuasive to me intellectually. But if I acted on that type of thinking historically, I would have done worse for myself than I have, which is to say I've done just about average, which is fine when it comes to the stock market.
That's why I don't short, because the market can remain irrational longer than I can remain solvent.
Okay. I can't believe you only have 2 minutes left. I've really mismanaged time here. But the good news is we still have 116 participants. Peter, this must be a record to have these many people still holding on to the end of a webinar. We can exchange statistics later, but this has got to be a pretty high number, 116. And I see there are lots of questions in the chat, and I apologize that we haven't been able to get to them. Many of my students from the macro class, Nicholas Henderson, Madeline Bow, Bano Burki, Mijin Kim, and Parth Sarthi Bajaj. Excellent questions. Betsy, there was one question, since you stressed the importance of CAPEX in holding up growth. The question is, do you see rising electricity prices affecting AI capital expenditures? Could energy constraints snowball into larger macro effects that affect the resilience of investment?
I don't think that in the short run, and I think that everyone sort of understands that demand for electricity is going to continue to grow, and so they're looking at ways to expand supply. But at the same time, I also think they're making enormous progress in reducing electricity demands in order to meet AI. So we were talking about Dario Amode's recent essay, and he said people are not worried enough about AI. And he's like, well, sometimes they're worried about things like what's going to happen to the labor market, which is a good thing to worry about. And sometimes they're worried about like water use, which is really not a good thing to be worried about. And so I sort of share his views on things like water and electricity.
wanted to use the last minute that I
just
don't
have to run here. I'm so sorry, but apologies. Thank you, Prakash.
All right. Thanks, Torsten. Peter and Betsy, both of you have written about housing affordability. Can you take the half second I don't have and just tell us why that has been on your radar?
I've been worried a lot just about overall affordability for families. So housing prices are up. Childcare has become increasingly unaffordable over decades. And then grocery prices are up. And even housing prices, a lot of that's a little bit mythical, right? Because if you look at what you're buying, what we see is millennials are buying a lot of house compared to what, baby boomers were doing at the same age, but they're spending a lot more. And so we see fewer people have houses, but the ones who have houses have nicer, bigger houses. We live in more square footage today than we did 30 years ago. But this mindset that everything's unaffordable, it's why I think 2026 might be the year where consumers finally put their money where their mouth is, and the decline in consumer confidence may show up as a decline in consumer spending.
Okay, thank you. Peter?
I'll just go along with what Betsy said. Makes sense.
All right, thank you all.
Prakash.
Bye-bye.
This was terrific.
Thanks.
Thank you.
Prakash.
Bye-bye.
Thank you.
Bye-bye.
Bye-bye.
Bye.